As discussed in the previous video, what we're going to be doing here is going through a basic financial model. I'm going to provide this to you at the end of this video, so you'll be able to download it and use it as a template to then begin making your own. What I've done is tried to lay it out in a pretty simple format just to kind of give you the core building blocks, and then from there we can take it elsewhere and make it fancy. So to begin with, the company name. So in this scenario, we just use the built-in Miami name. I put the date as of Saturday. The income statement, that's going to be where we see our revenue and expenses broken out across the 3 years that we're going to be projecting for. So you'll see that we've got 4 revenue streams that I've highlighted. We have 3 years that we're going to be looking at. We have some different accumulations of revenue, some growth rates. Down here you'll see we have a breakdown of our expenses across 5 major categories: general personnel, development, meaning anyone that's doing product or software development, general personnel referring to anybody that doesn't fit in development or sales and marketing, and you'll see why in a second. General expenses, so think of this as your operating expenses, things that just keep the business afloat. Sales and marketing, of course, anything that's helping you generate revenue. Legal, of course, there's always legal expenses that come up, whether it's legal, accounting, professional services. I like to separate legal because it shows that you're really focused on it, because a lot of startups overlook it, and that's to their detriment. And then you have your projected operating profit, which is, your core revenue minus your core expenses before you get into anything fancy like your depreciation, your taxes, and everything else that comes with the accountants. Over here, you'll see that this just pulls your revenues from each year, brings them down to units of millions. So for example, this isn't 1.2, it's 1.2 million, and this isn't 0.2, it's 200,000, but it's 0.2 million. So here we're able to get a good visualization of at least the revenues coming in, the expenses going out, and it looks like we're projecting profitability the first time we're above the line in year 3. So as you can see from the income statement, or the basic income statement that we have here, the goal is to not only understand what is the split of the revenue that we've generated, what is the growth of the revenue that we're generating, what's the split of the expenses that we intend to spend, and then of course what's the total, and then of course the difference between the two, so we can get a sense of how profitable is the business. As you can see here, this is a perfect business validation kind of point of focus, where if you see that you're going to be, for example, $5, $10, $20 million in the red for as far as you can see, maybe there's a problem with the business. Maybe the revenues aren't high enough or being calculated correctly. Maybe the expenses are too high or they're being assumed improperly. There's questions that can come up and improvements that can get made. From here, we have our revenue projection. So the revenue projections area is designed to, of course, allow you to project out your revenue over 36 months. Now, I made this, the whole goal was to make it very simple in order to keep things easy for people to calculate on their own. So I've broken it down in this way, and of course, the more competent you are in Excel and the more you're willing to learn, the more you can make some changes here, but I would encourage you just proceed with caution so that way you don't accidentally break it and have to start from scratch. So the easiest way to think about it is in a model build, focusing on column B, just so you can kind of understand the flow. We have a certain amount of customer acquisition. So in this scenario, we're saying we're going to spend X hundreds of thousands or millions of dollars. We have a certain customer acquisition cost. So if we're spending 250 grand and our customer acquisition cost is $250, we do division there, and all of a sudden we can see how many sales we're making in year 1, right? The breakdown here, this is designed to be, this is the most probably difficult to understand section of the model, and it's just like this for simplicity's sake. And I'll explain more in function how it works when you see. But the punchline of it is, imagine this 250,000. This says I'm going to apply 100% of this capital to this revenue stream. So for example, if I put this as 0, now all of a sudden everything is going to zero out because there's no capital from that investment that's being allocated to acquiring customers from the subscription. If I put 100% here, now I'm saying, of that 250,000, let's use 100% of it to account for subscription. If I only wanted to say, let's say put half of that in subscription and the other half into units in terms of where I'm focusing my activities to generate revenue, I'd put both at 50%. And as you can probably see over here on the right, you see numbers are starting to calculate and change because now all of a sudden we're getting a certain amount of units, we're starting to get a split of the capital, and we can start to use this 250,000 and apply it. Now, this isn't a perfect split in the sense that I could just use another 50% here because this isn't deducting from this 250,000. What it's saying is, hey, let's use 125,000, apply it to this revenue stream. Now let's use another 125,000 and apply it to this revenue stream. And down here, for example, in Marketplace, if I put this at 100, it says, oh, let's use 100% of this 250,000 and apply it towards this revenue stream. It's designed to be flexible, so that way if you don't have, for example, a Marketplace revenue stream, you just put it at 0 because you are going to be doing no activities generating revenue there, so you can leave it there. In the same way, for this example, what I've done is I've built everything assuming that year 1, that's where 100% of my dollars and effort and focus is going towards generating subscription revenue and subscription type customers. So we're going to proceed with that. And then you'll see in year 2, I've staggered my revenue streams. That's when I start getting units of sales as well as a revenue stream. And then in year 3 is when the Marketplace factors in and I start to get revenue from there. So starting where we can start, the subscriptions. So subscriptions, keeping it very simple. The nice thing is all it is a certain amount of customers times a certain monthly subscription price. You multiply those two things together, you add them up each month, and all of a sudden you've got an annual revenue model. Now, does this factor in churn? Does this factor in big changes and big swings and seasonality? No. This is designed to give you just a general trend. For example, if you think you're gonna get 1,000 customers, but you know that churn's gonna be a little bit, I would aim for 900 customers in the model. You're factoring in churn by just assuming you're gonna get a little bit less customers because ultimately it comes out to the same effect. What I've done here in this assumptions column, you'll see F through H, this has a bunch of blue formulas or blue numbers, which from the previous presentation, you'll remember these can be edited and not break the model. So in this scenario, what I've done is said, hey, year 1, I'm charging $100 for the subscription. Year 2, I'm charging $200. Year 3, I'm charging $300. So as you can see, similar to, let's say, a Netflix, just more extreme, I'm increasing my price over time because the value's more clear. I'm more in line with a fair price, or I'm just, squeezing the market if that's what I'm trying to do. This is meant to be more an example than guidance in that way. Next is units. So for example, it's the number of units that you've sold times the sale price of the units times the profit margin. Again, trying to keep it very simple. So if you sold 1 unit at $100 and you had a 40% profit margin, 40% of 100 is $40. That means that you made $40 of profit. You had $60 in cost of goods sold expense, so the actual cost to actually create the business or the widget, the unit itself. And there you go. Again, in this scenario, what we're assuming, I kept the profitability each year the same, just to kind of keep it simple, but I increased the unit sales price, whether we're adding more features or functions, or whether we're simply rolling things up into a better customer base that can afford a higher price, whatever makes sense. Next is Marketplace. So you can imagine something like an Uber or a Lyft, or where you're facilitating a connection between two people. Of course, there's going to be a certain dollar value of that actual match. And then, of course, there's going to be a certain percentage of that you get. This could be, you think of it like Uber, where you're matching a driver and a rider. This could be a marketplace where you're connecting, a buyer to a seller, and you're taking the margin in between, or your commission, or your take rate. Again, you start getting into different fancy terms when it comes to each individual type of business. But what I would encourage here is, how do you make money, and how can you best simply represent it within the confines of this model? And if making matches and taking a percentage of that, of those unit values, is what makes sense to you, that's what you should use. And then last but not least, you'll see display ad revenue. Now you'll notice up here that there isn't a display ad revenue breakdown because the way we're doing the math for that revenue stream is a little bit different. So the way to think about it is display ad revenue is about the number of website impressions, right? The more impressions, the more views, the more unique visitors you can get, obviously the better. So in this scenario, the ad fill rate, which effectively is the fill rate, it's pretty self-explanatory, but it's how full is your ad in the sense the amount of ads that you can host, how many of them are you actually using? What's your utilization rate of your ad capacity, if that makes sense? And then what we look for here is, of course, cost per mil, which is how expensive is that one per 1,000 views or impressions, and what are advertisers willing to spend? So in this scenario, let's say we had 60,000 website impressions for this year 1 in J. Let's say we had an 80% ad fill rate and we charge $2 per. Then you'll see what I've done, just to kind of give you a better bird's eye view. This is year 1, and I'll explain more of the horizontal. I didn't want to overwhelm you too quick, but you can see column N through column Y is year 1. I didn't start the model by assuming I'm going to get tens of thousands of views on my brand new launch startup, so I wanted to make it more reasonable. So I didn't start anything until you see month 7. So from month 7 to month 12, that's 6 months at 10,000 each, so it's 60,000. So zooming back in here. So now we have 60,000 times this, of course, take rate as far as how much utilization we're getting, times the $2, and all of a sudden you get an actual revenue of 96,000 for the year. And that can be seen and broken out here according to the expectations. Perfect. Now you'll see at the very end, if I do this and I'm just hitting F2, which opens up the formula and allows me to see the calculation, then I can scroll from there. This is factoring in all of the revenue streams, the subscription, the units, the marketplace, and the display ad. So as I make changes, whether my marketplaces are at 0 or 100,000, it'll flow through and I'll be able to get an accurate sense of what is happening with my total revenue, both on an annual basis in J through L, and on a monthly basis. Perfect. So as you can see, F through H are full of assumptions in terms of assumptions that can be adjusted, moved. You see I staggered all 3 of my revenue streams to get a better sense of how they grew over time. You can adjust the different prices. You can adjust the growth rates. You can really move this thing as you like, changing very few numbers. The nice thing is if you want to grow faster, the 2 easiest things that you can do, either metaphorically or actually spend more money. So turn this 250 to 300, turn that 300 to 500, or start adjusting your customer acquisition cost. Now it's important to note, this is purely a paid for customer acquisition stream. What this is trying to do is keep it very simple for you. So imagine you spent $10 in customer acquisition, and then you went and did $10 of effort. So let's say it's $20 total, and your customer acquisition cost was $10. In this scenario, this would be a $20. You would have gotten one customer per $10, so you would have gotten 2 customers. Notice it's not a cash into advertising, it's the marketing investment. It's designed to represent the holistic activities that you're doing to generate interest, whether it's organic, inorganic, paid, free. You still have to create banners. You still have to print things. There, unfortunately, is always a cost, even in doing free things. So this little section of 6 cells can change your entire model based off of how aggressive you want to be, how much money or effort you want to put in, how high the expectation is on the number of customers, etc. Because as you can see, if I look at 250,000 and an average customer acquisition cost of $250, what this is roughly assuming is year 1, I'm going to have 1,000 customers. Now the question isn't, do I agree with these numbers, although the customer acquisition cost probably should be in line with what I could Google, but it's really, do I agree with this number? Because an investor doesn't go, could you spend 250,000? They go, can you get 1,000 customers? And then can you turn that 1,000 customers into almost 3,000 in 12 months? And then can you do it again, right? These are the things that they want to hear you defend, explain, walk them through, instill within them confidence. They do not want to be on shaky ground and have you go, I can definitely get 500,000 customers, especially if you're talking about a market where it's difficult to get 10 customers. In J through L, you'll see all of the different summaries designed to show not only how much you're spending and where the money, of course, is going, but also the amount of units that are appropriate within each category. So, for example, in subscriptions, it would be the total number of customers. In units, it would be the number of unit price. In marketplaces, it would be the actual amount of transactions that took place. And then, of course, in the display ad revenue, what it comes out to is how many views and how many impressions took place that month and, of course, that year. If you look over to the right, what you'll see is everything broken down year 1, month 1, and then it goes all the way to year 3, month 36, designed to give you a full 3-year view on what exactly you're investing in and where the revenue is being generated. So now we'll take a jump to the expense side. Expenses are a lot more standardized, so this is nice and easy. So you'll see we've got our summary. So we've got our C through E. This is going to be all the summaries for each year to allow you to look at it more quickly. If you look to the right, you'll see 36 months starting year 1, month 1, goes all the way to year 3, month 36. Again, breaking down everything so you can quickly and easily see on a monthly and an annual basis where your money's going. It's broken into 5 standardized categories to make life easy. Of course, you can adjust these, but if you don't have a good reason to, then I would, caution against it. So 1 is your general personnel. Think of anybody that's not doing product or doing sales and marketing, because if they're doing product stuff, then they're a part of, your product expense. Like a software developer would be a part of development expense, or a designer would be a part of a design expense, right? You've got your sales and marketing, which is, of course, your revenue generating bucket. So you want to keep all of those revenue generating expenses in one area. And then you've got effectively everybody else, your admins, your CFOs, your COOs, all these different types of people that are still, of course, very valuable and additive to the business, but they don't directly affect the product and they don't directly affect revenue generation. There's a different standard and a different expectation that we hold them to. So under general personnel, you'll see I left 3 blanks. So that way, if you want to come up with anybody in your own title or in your own company that's appropriate, you can factor them in here. And then I'll show you how to flow through the actual dollar values associated with them in just a moment. So you'll see in general personnel, there's only people. Every section is broken where appropriate. You'll see here's development into the people portion and the non-people portion. The people portion is designed to give a sense of hiring because, of course, with people, you have taxes, you have expectations, you have sequencing. When it comes to office expense or AWS expense, that's purely what is the math, what is the expense, what's the expectation. People, their titles, their timing, their compensation, these all vary, and they vary based off each individual startup circumstance. So under general personnel, you'll see we have nothing but section 1, the people section. In development, we have section 1, the people section, which includes, just for a baseline, a CTO, a senior software developer, and a junior software developer, along with 3 more fill-ins, but a section for general software expense. Now, this isn't your Gmail expense. This is your AWS. This is your 3 licenses per software developer because you're a specialized company that's $3,000 a month. This is those expenses that allow these people to do their job in the best way that they can. Below that, you'll have general expenses. So again, keeping it easy, you've got office space expense, think general, paper and office supplies. And then I built in 3 areas for you to add and pick your own adventure. And then last but not least, sales and marketing, very similar to development, where you've got a people section. I put the CMO for Chief Marketing Officer and the CSO. This is your sales officer, think head of sales, just designed to kind of keep it simple from an explanation basis. So you've got a section, of course, of people here, and then marketing. This can be your advertising expense. This can be your personnel expense, or excuse me, not your personnel. This can be the expense of the softwares that support your personnel. This is your Canva expense. Whatever it is you need in order to enable your sales and marketing professionals, this is where that goes. And last but not, or excuse me, second to last, we have our hiring schedule. So within the hiring schedule, this is designed to show when you're hiring someone, what does their expense look like over time and how are you factoring that in? So as you'll see, this mirrors the expense section with the general personnel, the software, and the sales and marketing, because if we go back to expense, you'll see there isn't anything here as far as personnel under general expenses. And of course, the other sections have what they need, which is the general development and sales and marketing. Excuse me, one other section to just quickly highlight is legal. So legal, you have three major sections that I focus on. Your corporate structure and contracts. So this is just getting the business up and running and getting the initial agreements and subsequent agreements created and reviewed. There's your intellectual property. So this is your copyright, your trademark, your patent, all the things that go into protecting the intellectual property of your business. And the last would be transaction. So this is your SAFE agreement, your convertible, your debt agreements, your Series A agreements, whatever it is that you're using to raise money. This is where the cost of that gets factored in, because of course there's always some legal expenses floating around. So under hiring, you'll see there's no section for legal as well, because of course there's no personnel that we're hiring for legal. We're not assuming that you're starting with a general counsel. We're assuming that there's a certain legal expense that's going to come per month or annually each year that we should account for. And of course, those expenses should factor into your unique business, whether you have lots of contracts, whether you have a lawyer friend that's appropriate in the startup world that's going to do all the work for a few percent of equity. You've got different options, and I would encourage you to make it most appropriate for you. So now we've got these people. Now, as you'll see, this is in green. That way it links to the previous selection. So that way, as we make changes, we don't have to worry about anything breaking. So for example, if I look under admin and I'm just going to use control back bracket, that's just a shortcut that allows me to pop backwards. So I'm going to go to that, if you'll see in the formula bar, expense projections B10. I'll pop back there. And if I change this to test, and then I come back to hiring schedule, you'll see it says test again. So, but if I was to, for example, write test here, you'll see I typed, I go back over here, there isn't a test here because I've broken the link, because the link was the second page back to here, not here to the second page. So I'm just going to edit undo both of those, and now we're back where we started. So at the top, we have our expense assumptions as far as the hiring table. So there's 4 categories that are always going to be accounted for. There's going to be an annual salary increase. There's going to be a certain percentage of bonus, and again, just keeping it simple as a percentage of base salary. There's going to be taxes associated with them. There's going to be benefits associated. And of course, each role and the stage of the company will change everything from the salary increase, the bonus percentage, the benefits, it all varies. So therefore, I made it so that you could change each one individually depending on the specific nature of your business. Here you'll see their annual comp. So let's say someone like the CEO was going to get paid $150,000. You'll see their bonus. So again, flowing this through, and I'm just using F2 to see the formula. So 150,000 times 20%, so that would be 30,000. If I look at taxes, that's both the annual comp and the bonus times the tax rate. So I see that's 27,000. If I go to benefits, let's say I'm providing them 9,000 in benefits, so 6% of 150,000 of the base salary. And let's say my salary increase is 10%. So that way everything is able to flow through on an annual basis as it flows. So now what I look here is I see my all-in compensation takes into account my annual comp, my bonus, and my taxes, along with my benefits, in order to lead to this number, which is of course my year 1 all-in of $216,000. This flows through to each individual within the business and allows you to get a sense of what their all-in compensation is going to be and what that actually factors into within your financial model, because this is the actual cost of hiring a $150,000 employee if you're factoring in all of the associated increases in benefits, etc. Now you'll see this section. This section is designed to be a switchboard. So think about it like this. Row 6 is our CEO column. So this says in month 1, I have 1 unit of CEO. I have 1 unit of CEO because, of course, you don't really need more than 1 unit of CEO. But if I was to pop down and go over here to, let's say, my junior developers, so we're going to look at column 15 in development, junior and senior developers, and I go over, I'm probably going to need multiple. So as you'll see in the beginning, I may start with only 1 developer and another 1 developer, but maybe I hire a second. So now instead of having 1 unit of developers, I have 2, and that carries forward. It's designed to be a representation of the amount of units within each category of person. So that way you can very easily hire and, metaphorically fire without doing any fancy math. So if I go, hey, you know what? I don't think I'm actually going to need the developer until month 20. I'm just going to make all of these month 1. So that way, or excuse me, 1 developer. So now it looks like I only have a single developer for months 1 through 19. And then starting month 20, I have my second developer. And again, these can be changed. What you don't want to do is have it bouncing back and forth where, for example, in month 13 I have 2, month 14 I have 1, month 15 I have 2. It's a very big question of, did you just fire someone for 30 days or how did that actually work out? And as you can see, because of the way that these flow, if you wanted to go, let's say, add insert X person here, then you could come and adjust their salary, adjust their bonus numbers, adjust how much you want to increase their salary by each year, figure out when you want to hire them. Let's say you wanted to hire person, insert person X. You wanted to hire them year 3, and you're only going to need 1 unit of them. That's what this currently tells me. And to show you this actually works, because this is very helpful, if you look on the expense side, you'll see, for example, we have our CEO, and based off of our all-in comp, it looks like it's going to be roughly 18 grand a month to keep this person going. So in this scenario, what if I needed 2 units of a CEO, just for example? So month 1, I'm going to say I need 2 CEOs. Month 2, I only need 1. If I go to my expense projection, I should expect to see double the amount of salary expense for the CEO, allowing you to very easily make some adjustments here to see how much more or less you need. And of course, this expense flows through to your monthly expense, which flows to your annual expense, which ultimately flows to your income statement. So you can see in just one quick change of changing this to a 2 or a 1, we have effectively updated and flowed through major changes in the model that allow us to plan and build and organize in a much more efficient way. Last but not least, you'll see the sources and uses. So I always much more focus on the uses because the sources of funds are, generally speaking, either your pocket or the investment. That being said, as you mature a little bit later, you'll have a sources section here which folds into account your revenue as well. But year 1, I'm very focused especially on just making sure I have enough money to cover my expenses, because revenues are always harder to generate than expenses, because you can always sign some expense agreements and all of a sudden they exist. Revenues, they come and they go. So what this is designed to do is to give you kind of the building blocks of how to think through the amount of capital that you may need to invest year 1. So those same 5 categories make their appearance. What this does is pull in the annual expense for that first year. So as you can see, this is 1.97. If I go over here to my expenses and I scroll to the bottom, I should see 1.197. So we have everything lined up nice and easy. What does this say? This is a projection. So it says, where's the allocation of funds? And you can see it's up to 100%. So it looks like 37% are going towards general personnel, 22% is going towards sales and marketing. We had a little for general, legal so small it's barely even being counted. So as you can see, there's some questions here. Is this the right use of funds? I don't know. Is 1% really appropriate for your general expenses? Is 37% really appropriate for your general personnel if you're spending 40% on development? This would tell me that you have a lot of development work left and you're spending very little on your sales and marketing. What's the nature of the expense here? This allows me to ask questions. Now you'll see we have this buffer section. We have this buffer section because it's always harder to predict the future than people think, and things are always much more expensive than people want them to be. So what this does is this adds a premium into each of these columns based off of where expenses tend to increase the most. For example, it's really tempting and easy to increase your development and sales and marketing expense because there's always new features and functions and there's always new ways to spend money to try and make money. So having a buffer of, call it 20% of the value, probably a good idea, because that only translates to, for example, 478 into 574. So it adds another 100 grand, which is less than the annual cost of one developer. So as you can see, there's an argument here to maybe even make that number bigger. Same thing with the sales and marketing, and then of course with the other percentages such as general expenses, general personnel, and legal, we've left it a much more reasonable 10%. So now you take into account all these buffers, and a financial need for year one goes from 1.2 to almost 1.4. And then down here, I just have a very simple formula just to help round everything and make it nice and easy, because nobody wants to raise a really ugly looking capital number like that. So in this scenario, what this model tells me based off of its current assumptions is that we need $1.4 million in order to spend everything that we want year one, which then gets us to year two. So almost the end, bouncing back. Income statement. Now, as you can see, as you flow through your changes and updates and thoughts through the revenues, the expenses, the hiring, and you start reviewing your sources and uses, once you make the changes here, you're going to want to come back to your income statement and read your financial model. Does it make sense? When I look at this and go, I've got 2 revenue streams activated year 1, 3 year 2, 4 year 3. Does that seem reasonable? Does the amount of revenue per revenue stream seem reasonable? If I go into the revenue projections, does the amount of customers that I'm estimating I'm going to receive seem reasonable based off of my revenue expectations? This is a big exercise in, is this believable and can you defend it? So that's our revenue side. On the expense side, much the same. Not only are you under assuming how expensive something's going to be, are you over assuming how much capital you're going to need? And within both of those, are you allocating the funds appropriately, regardless of how much money you're getting? Are you over prioritizing executive compensation versus, for example, software development? You have to think about the narrative that the investor is going to hear when you show them the model. And if you have 80% of your money going towards bonuses and 10% towards sales and 10% towards other, that doesn't exactly inspire a lot of confidence. So what you want to look at here is, what's the allocation? Am I comfortable with this? If I had to present this and justify it to an investor, could I? And it's not bad that executives make money, but it's about what stage, what's appropriate, and what's the messaging around it. So let me pause here. So hopefully this was a good overview within the financial model to give you a good basis for how to build one, how to get started, how to think through the core concepts. If this model doesn't meet your needs, what I would encourage you to do is use it at a minimum as a reference. There's a certain amount of clarity and readability, legibility that comes with financial models that not a lot of financial models kind of give to people that are trying to review. This has been a tried and true type structure and formula, so we want to encourage you to at least use it as a base and then build from there. So, of course, feel free to reach out. Let me know if you have any questions. This has been Aaron, and we'll chat very soon.